Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about OneSource Source Corporation Annual Report. First Source Corporation provides a wide range of financial services to its clients. The company's consumer banking services include checking and savings accounts, certificates of deposit, individual retirement accounts, online and mobile banking products, and various loan options such as real estate mortgage loans and home equity lines of credit. In addition to these services, the company offers commercial banking solutions for businesses, including general corporate purposes financing, equipment leasing, and treasury management. It also provides trust and wealth advisory services, which include administration of estates and personal trusts, investment account management, and retirement planning. Furthermore, First Source Corporation offers insurance products and services, including property, casualty, health, and life insurance for individuals and businesses. The company's equipment financing options cover a broad range of assets, from construction equipment to aircraft and vehicles. Overall, the company provides a comprehensive suite of financial services that cater to both individual and business clients. The stock price of First Source Corp. (SRCE) has increased by over 9.69% in the past year due to several key factors. One major contributor was the company's strong quarterly financial results, which consistently exceeded analyst expectations and demonstrated significant growth in earnings, margins, and shareholder dividends. In particular, the record first quarter of 2025 saw a 19.69% increase in diluted net income per common share, while the second quarter reported a year-over-year increase in net income. The third quarter also set records, with a 13.34% increase from the previous quarter and 21.06% from the same period in 2024. The company's commitment to increasing shareholder dividends was another significant factor in its stock price appreciation. With a 32nd consecutive year of dividend growth, First Source Corp demonstrated its dedication to returning value to shareholders. The approval of increased cash dividends, including an 11.76% increase from the prior year, further supported this trend. Positive analyst sentiment also played a role in the stock's upward trend. Following the release of strong full-year 2025 results, several analysts raised their price targets for SRCE stock and reissued buy ratings on the shares. This collective support from financial experts contributed to the stock's appreciation throughout the year, culminating in a total return of 20.69% over the past year as of January 22, 2026. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a financial institution can be categorized into several key areas. On the positive side, trust and wealth advisory fees have been increasing steadily over the past 2 years, with a 4.34% rise in 2025 and a 12.67% jump in 2024. Service charges on deposit accounts have also seen growth, albeit at a slower pace, with a 2.38% increase in 2025 and a 1% rise in 2024. Insurance commissions have experienced significant growth, rising by 14.41% in 2025 after a decline of 2.62% in 2024. Additionally, the sale of available-for-sale debt securities has generated substantial revenue, with proceeds totaling $254,500 in 2025. On the other hand, some areas have seen declines in revenue. Mortgage banking income has decreased by 2.54% in 2025 after a significant increase of 21.29% in 2024. Equipment rental income has also declined sharply, falling by 41.58% in 2025 and 41.48% in 2024. Other factors that can impact revenue growth or decline include interest rate fluctuations, climate change initiatives, economic conditions, market declines, and regulatory expectations. Additionally, the institution's dependence on third-party vendors, technology security breaches, loss of key management personnel, and reputational risks can also have a negative impact on revenue. The net income of a company underwent significant fluctuations between 2023 and 2025. Initially, it increased by $7,684 from 2023 to 2024, indicating a positive trend. However, this growth was short-lived, as the net income decreased by $25,641 from 2024 to 2025. Despite this decline, the net income still managed to increase by 19.3% from 2023 to 2025. The profit margins of the company also experienced changes during this period. The net interest margin saw an increase, but the exact value for 2025 is unknown. Conversely, the non-interest income margin decreased from 12.5% in 2024 to an unknown value in 2025. Furthermore, the operating margin, net income/total revenue, also decreased from 77.8% in 2024 to an unknown value in 2025. The lack of direct information for 2025's profit margins makes it challenging to pinpoint the exact reasons behind these changes. The company is indeed generating positive operating cash flow. The financial data provided in the summary supports this conclusion. On page 51 of the report, it is stated that the net change in operating activities has been consistently positive for all 3 years from 2023 to 2025, with figures of $187,936, $193,853, and $223,117, respectively. Furthermore, the operating cash flow summary on page 94 confirms this trend. The company's operating cash flow has increased over the past 3 years, with amounts of $47,421 in 2023, $51,612 in 2024, and $65,654 in 2025. This upward trend indicates a positive direction for the company's financial health. The company's debt level has undergone significant fluctuations over the past few years. While total debt decreased from $7,750,432 to $7,737,180 in some instances, other pages show an increase in long-term debt and mandatorily redeemable securities. However, a closer look reveals that these increases are relatively small, with a 13.5% rise in long-term debt being the most notable. In terms of interest expenses, there is a clear trend of significant increases. Interest expense decreased from $183,200 to $166,219 between 2024 and 2025, but this was followed by a substantial jump from $114,739 in 2023 to $177,976 in 2025. The total interest expense also rose from $2.97 million in 2023 to $4.48 million in 2025. Overall, while the company's debt level has decreased slightly, the increase in interest expenses is a more pronounced trend. This suggests that the company may be facing higher borrowing costs or increased financial obligations. Management is optimistic about the company's outlook, citing a decisive change in federal bank regulatory activity as a key driver of growth. They plan to take advantage of relaxed regulations to engage in digital asset activities and de novo charter applications. The company is well positioned for continued growth, with expansion into new markets and increased market share on the horizon. Management is focused on delivering personalized services and listening to clients' needs to make doing business with the company convenient. They are targeting improvements in financial performance through cost control measures and expect to see an increase in non-interest expense in 2025. The company's strong liquidity position will support its growth trajectory, and management remains committed to prudent strategies to maintain this position. However, management also acknowledges uncertainty in domestic growth, trade policy changes, elevated inflation and interest rates, foreign conflicts, and geopolitical instability. As a result, the company is cautious about its forward outlook, with fragile growth expectations and a broader range of potential negative macroeconomic outcomes. Despite these challenges, the company's investments in variable interest entities, VIEs, support regulatory compliance and emphasize community development and affordable housing. The company has a history of distributing wealth to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts in recent years, with totals of $33,074 in 2023, $35,396 in 2024, and $38,430 in 2025. These payments are not only made to external shareholders, but also include receipts from subsidiaries. In addition to dividend payments, the company has also engaged in share buybacks, purchasing a total of 233,033 shares over the past 3 years. This program allows the company to reduce its outstanding share count and potentially boost earnings per share for existing investors. Furthermore, the company still has authorization to purchase up to an additional 766,967 shares under this program. Concerns about inventory buildup and supply chain disruption are evident in various industries. On page 29, the front-loading of inventory purchases due to tariffs has led to concerns about inventory buildup and supply chain disruption caused by shifting trade policies. Similarly, on page 30, rising trade tensions, low demand in the recreational vehicle industry, and stabilizing freight rates have raised concerns about inventory buildup or supply chain disruption. In other industries, such as aircraft manufacturing, there are concerns about inventory buildup due to increased availability of inventory, page 31. However, not all pages indicate concerns about inventory buildup or supply chain disruption. Pages 14, 26, 51, 56, 60, 74, 76, and 89 mention no such concerns. The broad instability and elevated interest rates have also raised concerns about small businesses' ability to manage expenses, page 70. Overall, the extracted summaries suggest that inventory buildup and supply chain disruption are significant concerns in various industries. That concludes the financial summary for OneSource Corporation. Feel free to comment below, and I will be happy to answer them when possible.